Wall Street's takeover of crypto has already begun. Bitcoin's hovering just above that $100,000 line, trying to find its footing after weeks of heavy selling. Altcoins are in free fall too. Charts across the board are bleeding red, and the mood in the market has turned cold. You can literally feel the uncertainty creeping in. Every bounce gets sold and every rally fades faster. However, something deeper is shifting beneath all this chaos. This doesn't feel like a normal correction. It feels like the kind of move that decides who stays in control when the dust finally settles. So in the next few minutes, I'll show you what's really happening behind this $100,000 Bitcoin crisis, what the data reveals that most traders are missing, and perhaps most importantly, I'll show you why this stretch might end up being remembered as the turning point for Bitcoin's future and hopefully yours as well. So let's get into it. All right, so as we get started, as I was saying, Bitcoin is standing at a crossroads. After more than 6 months above 6 figures, the market has finally cracked, and everyone feels it. The sell-off that started as a healthy pullback is now turning into a full-scale correction. Right now, Bitcoin trades around $103,000. It's holding that psychological barrier, but every candle looks heavy. Volume is thin and volatility is back. The fear is spreading across every other asset on the board. And altcoins have been hit even harder. Double-digit drops in a week. Liquidity vanishing from the mid-caps. And entire ecosystems watching their cycle gains unwind. It's truly one of those moments that shakes you to your core, and as I always say, begs you to answer the question on who you are, what you're doing, what your strategy is, because only those that know how to answer these questions and feel confident in their positions and are not over leveraged stand and are feeling fine right now. That said, analysts at the QCP group called $100,000 the line in the sand, the level where ETF outflows, forced liquidations, and dealer hedging all collide. That line now acts as the true test of conviction for both sides. Each bounce from here looks heavier, but it's also the same zone that built this cycle's foundation, the level defended by months of volume and steady accumulation. And at the same time, global markets look disconnected. The NASDAQ keeps pushing toward new highs. Gold is soaring. And yet Bitcoin, the supposed risk barometer, keeps sliding. That divergence is starting to draw attention. It's rare to see stocks scream higher while crypto bleeds. And when it happens, the snapback move that follows is usually violent. CoinShares data shows Bitcoin's correlation with the NASDAQ climbing back to its highest point since 2023, when the Fed began cutting rates, while its inverse correlation to the dollar is returning. So in other words, the macro flows that drive global risk assets are still in control. As the dollar strengthens, liquidity drains, and Bitcoin feels it first. This is where the story starts to get interesting. Every chart shows stress, but beneath that stress, massive players are positioning for what comes next. The structure that's being tested right now will define the rest of this cycle. And the real pressure on this market isn't just price. It's liquidity. The Federal Reserve is sending mixed signals, and traders are losing faith in a December rate cut. The odds have dropped from 90% to 67%, and the DXY just hit a 5-month high of 100.36, showing how strong the dollar has become. When the dollar rises, risk assets like Bitcoin lose momentum because capital starts chasing after safer yields. ETF flows confirm the tightening. Over the past week, Bitcoin's spot ETF saw 1.3 billion in outflows, the first sustained selling streak since May. Meanwhile, Binance has listed more perpetual futures pairs this year more than in the last 3 years combined. The same pool of traders is now spread thin across hundreds of tokens. Liquidity is being diluted. It's like watching a river branch into hundreds of small streams. The current weakens everywhere. That's why every bounce in Bitcoin feels smaller. There's less concentrated volume to drive a breakout. Without a new liquidity catalyst, this $100,000 zone could turn from a launchpad into a long grind lower for some time. But then, of course, we'll recover from there and Bitcoin will be worth $1 million someday or more. So it's just a matter of time and persevering through the journey. That said, while the broader market panics, something very different is happening behind closed doors. Of course, Wall Street is quietly moving in. The headlines barely captured it too. But Ripple just pulled off one of the biggest institutional rounds in crypto history. $500 million at a $40 billion valuation. Fortress, Citadel Securities, Brevin Howard, Galaxy Digital, all part of the deal too. These are firms that don't gamble on hype. They build positions that last decades. And right now, in the middle of this shakeout, Ripple's stablecoin, RLUSD, just crossed a $1 billion market cap. The timing couldn't be more interesting. Retail sentiment is drained, but institutions are doubling down. Funding infrastructure, custody, payments, and compliance, while everyone else argues about the next step. And the US banking lobby is fighting back hard. The Bank Policy Institute just filed objections to Ripple's National Trust Bank Charter application, warning regulators that stablecoin issuers shouldn't be given shortcuts into the system. So on the surface, it looks like routine bureaucracy. However, underneath, it's a tug of war of who gets to control the next era of digital money. And Ripple is playing to win, as should we. In the past 2 years, they've spent more than $4 billion acquiring firms like G Treasury, Hidden Road, and wallet tech startup Palisade, building a complete institutional stack for global money movement. And at the same time, CoinShares released new data that flips one of the market's favorite myths on its head. For months, people have claimed Bitcoin's liquidity is vanishing because coins are leaving exchanges, when in reality, total dollar liquidity has never been higher. ETF trading volumes are exploding, and the value of liquid Bitcoin supply keeps climbing with price. The coins didn't disappear. They just moved into deeper institutional channels. So that's the quiet takeover in motion. Capital is flowing upward, away from retail exchanges, into structured vehicles, into the same firms that now own pieces of the traditional financial system. And you can sense a bigger hand organizing this chaos. But what looks like consolidation might actually be the preview to something else entirely. Macro investor Jordi Weiser calls this moment Bitcoin's silent IPO. His idea is simple but powerful. The early believers who carried Bitcoin through chaos, the miners, the OG wallets, the whales from the early days, are finally handing their supply to institutions. It's not emotional selling. It's a natural evolution. When companies go public, the same thing happens. Early investors take profits, founders diversify, and long-term holders step in. The stock often grinds sideways or corrects for months while that ownership transfer takes place. And it's the same dynamic we're seeing now, except this time it's happening on a global trillion-dollar scale. And we, everyone here, we are this retail, these early investors he's referencing. So don't be a statistic. Don't fall for the pattern. Don't sell. Remain a long-term holder. And if we look at the on-chain data, old coins that hadn't moved for years are waking up. But there's no panic in how they move. Transfers are measured, deliberate, flowing into ETF custodians and corporate treasuries. The market isn't fully collapsing. It's redistributing. Ownership is spreading wider than ever before. And that's why volatility feels different. Bitcoin's supply is slowly migrating from concentrated holders to diversified institutions. Every coin that changes hands this way makes the system more stable, less prone to shock. The price might be falling, but structure Structurally, Bitcoin is maturing. Meanwhile, sentiment has hit rock bottom. The fear and greed index sits near 23, near levels that have marked every major bottom of this cycle. And Glassnode reports that most short-term holders are now sitting on losses. Historically, that's when the transfer of power happens. We can sell into fear. Hopefully that's not you. Strong hands accumulate quietly. Hopefully that is you. And the foundation for the next move gets built. It feels slow, painful, even boring. But that's how every major reset starts. It's the quiet period before the next chapter begins. And all of this connects back to one trigger, that is liquidity. Arthur Hayes and Lynn Alden have been tracking the same pressure point in the system. Both see the Federal Reserve's standing repo facility acting like a hidden release valve, quietly waiting to open. Here's what that means in simple terms. The repo market is where banks and funds borrow short-term cash against treasury collateral. When the market tightens, it shows that dollars are scarce and funding is strained. The standing repo facility gives the Fed the power to inject liquidity instantly if stress builds too far. It works like a silent circuit breaker in the background, rarely discussed, but always ready. The Treasury General Account, or the TGA, is another key piece. It holds the government's cash balance, and right now, it sits above $850 billion. That number represents money sitting idle inside the government during its shutdown, instead of circulating through markets. The more the Treasury refills that account, the less liquidity is available for risk assets. When they spend from it, liquidity flows back. So together, these two mechanisms show how tight the system has become. Repo rates are hovering near the top of the Fed's target range, a sign that banks are holding onto their cash. And quantitative tightening continues through November, remember that, but is scheduled to end in December. And when that policy expires, and when the TGA starts drawing down again, the flow of money begins to move. The same setup appeared in 2016. The repo market ceased, the Fed stepped in, and a quiet wave of liquidity followed. That wave carried Bitcoin through the 2020 breakout. The conditions today look almost identical. Tight credit, rising dollar, and pressure building inside the funding system. These moments rarely announce themselves. Liquidity returns slowly, then accelerates all at once. By the time the data confirms it, the market has already started to move. So as we close out today's video, Bitcoin's $100,000 level crisis is more than price. It's the stress test for a system being rebuilt by Wall Street. Institutions are buying the infrastructure, regulatory clarity is forming, and liquidity is about to flip. You just have to endure. The bear case says we stay tight, the dollar keeps rising, and Bitcoin grinds sideways. But the bull case says the repo facility opens, the TGA drains, and the liquidity flood returns. Either way, this level defines the cycle. Wall Street's takeover of crypto is happening right now. Behind every red candle, Ripple, Citadel, and Fortress are proving it with capital. The only question left is when liquidity returns and whether Bitcoin breaks first or follows later. So stay sharp, stack sats, and keep watching the flows. And stay tuned in here because we're gonna cover everything that happens Monday through Friday so you know exactly what's going on and don't despair. And remember, when this flips, it won't announce itself. It'll just start. And by then, everyone still arguing over fear will already be too late. They will have missed the boat, which is not going to be you if you stay tuned in. So like the video, share the video. I love you guys so much. Just continue to endure, and congratulations to everyone who's been able to buy more Bitcoin and stays steady. And don't go put any leverage longs. I love you guys, and I'll catch you guys here tomorrow. Ciao.